Hi, everyone. My name is Michael Rothfuss, owner of Bell Retirement Strategies. Today, I'm going to be talking about how you may be able to receive penalty-free income from your retirement accounts prior to the age of 59 and a half. Let's get started. Many of the retirees that I work with primarily have two types of retirement accounts, which are traditional IRAs and 401ks. Now, of course, there are other retirement accounts like Roth IRAs and employer-sponsored accounts like 403b plans and 457 plans. But to simplify today's discussion, I'm primarily going to be talking about traditional IRAs and 401k plans. Now, if you're not quite yet of the age of 59 and a half, you may be subject to a 10% early withdrawal penalty when you take money out of these accounts. But what if you want to start taking money from these accounts and you're not yet 59 and a half? Well, under certain circumstances, the IRS does give some exceptions to the early withdrawal 10% penalty, and we're going to talk about some of them right now. Now, these exceptions to the 10% penalty are under the Internal Revenue Code Section 72T, and you may have heard of the term 72T before. Both IRAs and 401ks have a death and disability exception to the 10% early withdrawal penalty. However, death is not ideal for anyone, obviously. And disability, well, the IRS defines this as you are unable to engage in any substantial gainful activity due to a physical or mental condition. Then there are exceptions that only apply specifically to IRAs, and they are if you're using the proceeds for a first-time home purchase. Now, most retirees aren't in that situation. The other exception is qualified educational expenses, which are great if you're helping grandchildren, but not ideal for retirement income needs. When it comes to getting penalty-free income prior to the age of 59 and a half, the exceptions that are most important to retirees are the substantial equal periodic payment, or IRA SEP exception, which is generally referred to as 72T. The other rule, which specifically applies to 401ks, is the rule of age 55. We're going to focus on these two rules and talk about how they may fit in a retirement strategy for you. The IRS allows you to set up what's called a SEP, substantial equal periodic payments, and the amount that you can draw from the IRA is based on one of three calculation methods determined by the IRS, which depends on your life expectancy. Now, the problem with this arrangement is that once SEP income starts from an IRA, it cannot be altered. I'll give you an example. Let's say it's set up to supply you $1,000 per month. Well, you must continue to take this very exact amount every month for the duration of 5 years or until you're 59 and a half, but whatever is longer of those two time periods. If the arrangement is altered, either by taking $1 more or less on any given month, then the IRS applies a 10% retroactive penalty on every distribution going back to the start of the arrangement. So it's extremely important to be very careful when planning and doing a 72T SEP arrangement. The rule of age 55 applies specifically to 401ks. And what this rule says is that if you separate from your job in the year that you turn age 55, or if you're older than 55, then you have the availability to receive distributions directly from your 401k plan, and it will avoid the 10% early withdrawal penalty. Of course, you'll still have to pay taxes on any withdrawals that come out of the plan. Also note that when doing a distribution directly from a 401k, the IRS mandates that your plan administrator withhold a mandatory 20% federal tax withholding. The rule of age 55 may be a great way to bridge the income for those that are just a few years away from age 59 and a half and avoid utilizing the SEP strategy from the IRA. Now let's take a look together at 3 different retirement scenarios and see how each age group can utilize these rules we just talked about in different situations and to avoid the 10% early withdrawal penalty. We're going to take a look at those that retire above the age of 59 and a half. We'll next take a look at someone who's retiring between the age of 55 but not quite 59 and a half. And then we'll last take a look at someone who's retiring younger and under the age of 55. Many clients that I work with had primarily 2 main sources to fund their retirement, and those are typically their pension and their 401k. So in these examples, I'm going to be making some assumptions that the person that we're talking about is choosing their pension as a lump sum distribution. We're also going to be talking about pre-tax, also known as traditional 401k contributions. Because if you have Roth or after-tax contributions, you don't have to worry about a 10% penalty because you can access those contributions anytime without a penalty. Let's take a look at the first scenario. This is the more simplistic example of the three I'm going to show. Because here, this person is over the age of 59 and a half, so they don't have to worry about an early 10% withdrawal penalty. Also, this person is going to be doing an institution-to-institution rollover of both their lump sum distribution and their final distribution from their 401k. At that point, this person then receives monthly income from their IRA and is only going to pay taxes on the income they receive, while the money they don't use continues to stay tax deferred. Now let's take a look at the next example, who is someone between the ages of 55 and 59 and a half. Let's say they're age 57 here. Now remember the rule of age 55. If you retire or separate from service in the year in which you turn 55 or older, and you leave some assets in your 401k plan, then you can avoid the IRS 10% early withdrawal penalty by taking a direct distribution from your 401k. But you must keep the assets in the 401k plan, because if you roll it over into an IRA, the distribution age then moves back up to 59 and a half, and you'll be subject to a 10% early withdrawal penalty from an IRA. This strategy may work well for someone who's just a few years away from 59 and a half. So if they're age 57, this person can take distributions directly from their 401k over the next 2 years, and then once they reach age 59 and a half, their IRA assets are penalty-free as well. Using this strategy may be a great way to avoid the inflexibility distribution rules that come along with the 72T SEP rule, which we're going to talk about in the next example. Now let's look at someone who retires before age 55. This is a more advanced strategy, and remember, because of the strict rules that come with utilizing a 72T SEP arrangement, it should be considered a last financial resort. Here, both the lump sum pension and the 401k are going to be rolled over into an IRA. Next, you can spin off one or two other IRAs. One of the IRAs begins 72T distributions and is funded only with enough to provide the needed income target. And that's very important. You only want to put enough to fund the target income you need, because labeling all of your assets as a 72T IRA is not a good idea, and it leaves you little room for other income options because of the strict distribution rules you've set up. So you only want to put what you need into the 72T and leave yourself some flexibility with non-72T assets to possibly spin off additional income if it's needed during the original arrangement. The non-72T IRAs can continue to stay separate until age 59 and a half or until income is needed from them. This strategy gives the client some flexibility with their accounts and doesn't lock up all the assets into the strict rules of the 72T arrangement. Here's a visual slide to explain how long one must take 72T distributions. Remember, the SEP must continue to be taken for 5 years or until you're age 59 and a half, but whatever is longer of those two scenarios. So someone who's age 52 has to continue taking 72T SEP payments for the next 7.5 years, because turning age 59 and a half is the longer time frame. Someone who's age 54 has to also take 72T payments until they're age 59 and a half, because that is the longer time frame. And someone who's age 58 must continue to take 72T payments beyond age 59 and a half, because the 5 years is the longer time frame. The SEP income can be taken either monthly, quarterly, or annually. It doesn't matter as long as the income comes out of the account. Withdrawing money early from a retirement account is a financial last resort. This is why the IRS has exceptions for specific circumstances like disability and illness. And if you don't meet other criteria for other exceptions, then the Rule 72T SEP payments can be used if you have exhausted all other avenues. It should not be used as an emergency fund strategy, because any withdrawals could affect your future financial stability significantly. Ideally, when it comes to deciding to retire, I'd like to think that you should consider two things. One, you want to retire, and two, you can afford to. Now, the first point when you want to retire is a personal question that can only be answered by you as an individual. But the second point is one that I can help with. I can help you gather all the pieces, which include your assets, your Social Security claiming strategy, your debts, your expenses, and your income need, and build a plan around your individual unique situation. You can call me and schedule an appointment at 610-989-2808 or go to my website, bellretirement.com. I'm Michael Rothfuss. Thanks for watching.